Yes, certainly. So my name's Arthur Kemp. I've been doing capital allowances now for the last 12 years. Part of my history, if you like, and how I sort of came about this quite rare tax relief is that I used to be the UK accounting manager for IKEA, and part of our role was to sort of forecast how much tax we had to pay, and being quite a profitable company, it was quite a lot normally, and so we were sort of tasked locally for finding out ways to mitigate tax, and of course capital allowances was one of these things, and I was involved in the project to sort of organise that initially, and having IKEA at the time, IKEA had £2 billion of commercial property, and they weren't necessarily being advised properly by their advisors. And so I thought to myself, well, okay, in a few years' time, there's a real opportunity there to share that knowledge with the individuals. So people, the smaller property owners and property developers, if you like, who won't know about capital allowances, but it can make such a massive value, such a massive impact to the way that people operate their business, and just knowing about it. So that's all we do. We've got our company is Exact Capital Allowances. We don't do tax returns. All we do is sort of surveys and value plant and machinery that I'll come on to later. And basically, we save people money off their tax bills, which everybody's generally quite happy to do.
Yeah, that sounds like you do a good thing. Do you have any slides or anything to share?
Absolutely, yeah. So if I share my screen, I'll just go over this. If you can all see that.
Yeah, that's all good this side. What I'll do is I'll just come off audio and video just so we get the best possible connection for you.
Yeah, perfect. Thank you. Well, yeah, thanks very much. It's great to be talking to you all here. What I'll do today is capital allowance is quite a complex subject. So what I'll do is I'll just go over a few of the basics, some new rules. It's mainly geared around sort of commercial conversions, not necessarily commercials, property, all kind of properties that you would convert. And yeah, to just take some knowledge. There's lots of questions. Obviously, there might be around capital allowances as well. But I'll run through it and we'll go from there. So this is really all about sharing knowledge of capital allowances, just seeing how it might apply to your particular situation. So I explained a bit about capital allowances in terms of my coming to capital allowances from an accounting background, but capital allowances kind of sits nicely between tax, surveying and law, really. It's sort of in the middle there in terms of how it sort of sits. So you need to know a bit of knowledge about all of those areas in order to apply the legislation, to undertake the valuations and to really see how it applies to your own situation. But don't take my word for it. This is what the revenue say. So this is HMRC themselves on the websites. They say you can actually claim capital allowances when you buy assets that you keep in your business. And it talks about a few things, namely called plant and machinery. Now, normally people assume that plant and machinery is diggers and tractors and silos and all those things. Well, yes, that is plant and machinery, but in property law, that's not plant and machinery. Generally speaking, it's all of those second fix items that you get when you're fitting out a property or buying property that you can claim on. So as far as that's concerned, what you do is the value of that plant and machinery, you have that as a tax deductible business expense, which you can use to help reduce your taxable profits and therefore stop paying any tax, or certainly mitigate a large amount of tax. So when you claim these allowances, you're allowed to claim them whenever you spend money on a property. So the property life cycle is typically you buy a property and you might wish to develop it, and then in the long term you may decide to sell it. But whenever you're spending money on the property, you will incur some items of plant and machinery. Because when you buy a property, you don't just buy the foundations and the walls, you buy all the sockets and the pipe work and the heating systems, for example. All of those items of plant and machinery you buy as part of the property. So what we do is we break down the cost of that purchase into its component parts, and one of which you can claim tax relief on. And also, when you develop a property, you're adding in more plant and machinery, so you can do that as well. So whenever you spend money on a property, that's when you're able to claim. Now, some people think, and it perhaps might help some people to understand what capital allowances are, as tax depreciation. So you'll all be aware of what a profit and loss account is, where you have some your various incomes from your business and rental income, for example, and you have all of these operating costs. So you'll have your wages, and you might have some computer equipment and gas, electricity costs, all of the costs, and you end up with net profit, hopefully, at the end of the year. One of those lines is a line for depreciation, which your accountant will work out. So that's where you spread the cost of your assets over their economic life, effectively. Now, that depreciation line is not a tax-deductible business expense. So when your accountant gives you your management accounts, you will have a depreciation line in there for all of your various assets. But when it comes to working out your tax, he has to completely ignore the depreciation part of it. But instead, and for the last 150 odd years, you were able to claim capital allowances instead. But the problem is, A, not many people know about it, and B, it's very difficult to quantify. You don't take a straight percentage of the purchase price of a property. You actually have to log and detail everything that you're claiming capital allowances on. So that's one of the first things to consider. And again, it's available for your fixed assets only. So if you have your balance sheet, if you have all your assets, it will be for your property that's in your balance sheet on there. I'll explain that a bit more later on. So who can claim capital allowances? Well, it's whoever owns the property that's able to claim. So very popular these days are limited companies, what with the interest rates relief not being available. Lots of people are putting property in limited companies. So if your limited company owns a qualifying property, then it's that limited company that will claim the allowances and therefore reduce their corporation tax liabilities. If you have the property individually or with a partner or a business partner, then each of those partners are entitled to claim profits and losses and capital allowances, their share of those for that particular property. And if it's through an LLP structure, then the LLPs, each member is entitled to their share of the capital allowances on those properties as well. The legislation is the Capital Allowances Act 2001. I know you've all read it. It's not the most exciting read in the world, I'll grant you, but it can save you lots of money, so it's very good. And it's very straightforward to claim as well. Through your tax return, you simply put the right numbers in the right boxes and you get all the benefit there. And something else which is asked fairly frequently is about the planning status. The planning status of a property has no impact on you being able to claim capital allowances or not. It's really based on how the property is traded. We'll come on to that shortly. But yeah, just to give you an idea of the sort of values we're talking about, and this is very rough, if you like. It's easy maths, you know, so you can multiply it up. But generally speaking, and to keep the maths fairly simple, I'm going to split it down into commercial type properties and more sort of residential type properties that you can claim for capital allowances. And what I've done here, as I said, well, okay, for each £100,000 that you've got, the plant and machinery that we'd expect to find in a property will be £20,000. It's probably going to be a bit more, but as an idea, and to work it out very quickly in your head, £20,000 worth of plant and machinery you should expect at least on your £100,000 investment. The next line is something that is unique to commercial properties because October 18, the government introduced something called Structure and Buildings Allowance. Now, Structure and Buildings Allowance is a tax relief which relates to commercial properties only on the actual depreciation for the structure of the property. And there was quite a few countries around the world, certainly in Europe, that allowed a depreciation for the structure of a property on there as well. You don't get that in residential type properties, but Structure and Buildings Allowance is actually quite valuable. But just to sort of reiterate on these, the plant and machinery allowances, you can get them straight away. The first year when you buy a property, you can claim all of those. The Structure and Buildings Allowance, you still get that, but they give it to you at 3% a year. It was 2%, but they increased it to 3% a year. So you will get all of that £45,000, but over the next 30 years, obviously, 33 years. So looking at your £100,000 investment for a commercial property, you'd expect to get about £65,000 tax relief. But that's massive. 65% of your purchase price you can actually get as a tax deduction. And what that means in terms of the actual value it's going to save you is, well, that's the allowances you can claim, but what is your tax rate? So if you have a commercial property in your own personal name and you're a higher rate taxpayer, well, you could save on a £100,000 purchase up to £26,000, which you think about it, that's a massive amount of saving based on your investment there. And if you're a lower rate taxpayer, standard rate taxpayer, you can save probably £13,000. But even for a HMO, if you've got £20,000 worth of capital allowances, that's £20,000 worth of profits that you can make before you start paying any tax. And if you're a higher rate taxpayer, that'll save you £8,000. So that's potentially 8% of a reduction in your net investment in the property there, which is quite it's not a small amount to consider. But on top of that, that's just the purchase. You can also get massive amounts of capital allowances on the development works as well. So, and again, that can range, depending on the type of developments you're going to do, between 30 and 75%. If there's not going to be much restructuring or remodeling of the property, and it's just sort of new plant and machinery going in, obviously there'll be a higher proportion of the costs that are going to be development works and plant and machinery. So there's a few things here that we should be aware of. First of all, one of the great things about capital allowances is that you can use them against any income stream. And that's really quite powerful, because lots of people are buying properties, getting the capital allowances, offsetting it against their PAYE income, and then getting the tax back that they've paid through their job. And that's a great way to start or help to start your property business, your property career, so that you can use that money that you've already paid in tax that you're entitled to get back through sideways loss relief. There's some restrictions on the actual amounts there, and I'm sure Josh can go through that in a lot more detail. But effectively, sideways loss relief is a great advantage. There's very few taxes that you can benefit from across other streams, and capital allowances is one of them. So another good thing is that it was introduced in 1878 originally. Back then it was called wear and tear allowance, which is different to the more recent wear and tear allowance, but it's legislated for, so it's not some sort of fancy tax loophole that some Man United footballers might be interested in. It's a genuine tax relief that you're entitled to claim. And it applies to a whole host of properties, and I'll go into that detail a bit more later. And a few years ago now, the Revenue said that of all of the property transactions that took place, 96% didn't maximise their capital allowances. And that's a massive opportunity for people that are listening to take away the knowledge of capital allowances. And what we've found is, over the last 12 years, generally, people who are selling properties where our clients are buying them, they haven't got a clue about capital allowances. I would say less than 1% actually have any idea what capital allowances are. And the vast majority of people are not necessarily interested in getting the tax relief. They want to sell their property, get the price they want for their property, and then move on to the next thing. So it's a great opportunity for people who don't know about capital allowances. You guys can maximise on it at all as well. Another positive thing is it doesn't affect your capital gains tax. Whether you claim capital allowances or not, you will still have the same CGT liability when you come to sell the property. And between 8 and 150% of what you spend on a property can be claimed as well. And I'll go into that a little bit more later. But I guess from a converting a property perspective, I guess one of the big questions is, do you flip your property, or are you going to keep it? That depends on what your sort of skill sets are, how you want to trade effectively. And that's an important question to ask, because it can depend on the benefits of capital allowances that might be available. And I'll just briefly explain those. If you're a developer and you're flipping properties, then your property is not a fixed asset. You can only claim capital allowances on fixed asset properties. And if you're a developer, you're buying a property, you're flipping it, you're creating a better property and selling it on quickly. Therefore, you get taxed on the income, the profits that you make from that property. So therefore, it's a stock property. It's not your fixed asset. You're not keeping hold of it. There's generally there's no capital allowances available to you there. But if you're going to keep the property, then your investor, will be your fixed asset, and you're entitled to get full capital allowances on the property. So I think it's important to know how you're going to approach that particular property transaction and the benefits. You can factor in the capital allowances on there if you need to as well. So which properties qualify for capital allowances? Well, this goes back to the legislation. The legislation says that you cannot claim capital allowances on a dwelling house. So if it's somebody's main residence, then generally you can't claim. There's a few sort of other areas, but if it's a single buy-to-let property, it's quite clear that it's a home, it's somebody's property, and you can't claim capital allowances on there. Most properties that we see are commercial properties. So we're talking, it's generally sort of dental practices, offices, B&Bs, sort of retail spaces as well. They're pretty, well, they are black and white in the sense that there's no dwelling areas, so you can claim for capital allowances on the whole of the property. However, there's also very popular as well mixed use properties, and certainly people who are buying mixed use properties, they can look at this and go, well, okay, the commercial part of it, yes, very clear and straightforward. You can claim capital allowances for that bit. The upstairs might be single buy-to-let flats. You wouldn't be able to claim for those, but you could claim for the communal access areas to those as well. However, if those flats that come with a mixed-use property are serviced accommodation or holiday lets, where you're providing some short-term rental, then of course you can claim capital allowances for those, the plant and machinery in those areas as well. So it depends exactly on the property that you've got or you're thinking of buying, and exactly how it's trading as well on there. You can claim on residential property if you're then going to convert it into a qualifying property, so into offices or serviced accommodation or holiday lets or B&B or whatever it might be. Then as part of the whole project costs, you can claim the plant and machinery on the purchase of that property, even though it was residential. But if you're buying a single buy-to-let unit and you're going to extend it, expand it, and keep it as a single buy-to-let unit, then it's a dwelling house in its entirety both times, so you wouldn't be able to claim for those. Just to sort of be clear on that. Now, blocks of flats, again, quite a few people are investing in blocks of flats, which I think is great. But if they're all single buy-to-let flats, of course, you wouldn't be able to claim for those. But the communal access areas, then you could. Again, if you bought a block of flats and it was all holiday flats, then brilliant. The whole property would then be able to qualify for capital allowances and would be able to extract all of the plant and machinery values from there. So I'll put HMOs in there. I can explain a lot more detail on HMOs. I don't have the time, unfortunately, today, but HMO properties are interesting. There's been a recent case law back end of last year, specifically around HMO properties, and the case law now says that you can claim for what they call common areas. It went on to explain that in a HMO there are dwelling areas which belong solely for the tenants, which you certainly can't claim on, and there's also communal areas which provide the tenants facilities. You can't claim on those either, but the judge said on common areas which don't provide facilities to the tenants, you can claim capital allowances on there. Well, that's not really an awful lot of space, but also what the judgment did say is for the whole property, you're able to claim installations. So that's generally all the electrical supplies, gas, security, and a couple of other things as well for the whole property, irrespective if it's the dwelling areas or not. And that's where a lot of the value is. So based on this new case law, we're seeing about 13 to 17%, 15% on average of capital allowances being available for HMO properties. So again, that might be something that's useful for people there. So just to go over this, capital allowances is brilliant to not pay any tax. You can utilize capital allowances, you can plan for it, it has a cash value. So when you're forecasting your profits for next year, factor into it there's capital allowances may be available, and that can certainly mean that you pay an awful lot less tax, which is always a good thing. Looking, and again, knowing that properties will benefit from capital allowances, it might help you look at projects in a slightly different way to say, well, okay, if I'm calculating the yield for a particular project and I can get rental income of this, and I might have to pay tax on that, and I know that the cost is going to be X, then you can work out what the yield is going to be. if that cost of your property was reduced because you're saving tax or getting tax back, then of course your return on your investment goes up. So if you're looking at a particular project which might have a return of, let's say, 2 or 3% or 4 or 5%, you might be thinking that's potentially viable. But if you factor in capital allowances, that could make quite a big difference, sometimes up to more than 11%. And so all of a sudden, projects which you might be looking at thinking that's not viable, they could actually become something that might be more interesting to you. And again, the best thing about capital allowances, because it has a cash value, it helps you keep hold of your hard-earned money so you can reinvest it into your property portfolio. And again, being a smarter investor means that all the people you're in competition with and all the people that you're dealing with might not necessarily know about capital allowances, especially when you're buying a property. It's really useful to know who you're buying the property from. And again, you can leverage your knowledge on capital allowances to your benefit against other people who don't know about it. So plant and machinery, as I said, the last 152 years now of case law we've had has had all these various things which are then deemed to be plant and machinery. There's no definitive list, but this is kind of a good idea of the sort of things to expect. You've got gas sewage systems there, cookers, hoists, sound insulation. Again, all these things we pick up when we do the site surveys and go through. Fire alarm systems, you've got burglar systems there, you've got cold stores, you've got a dry dock, number 23. If anyone's got a dry dock in their portfolio, your quid's in because you can claim capital allowances on that. Yeah, a whole host of other things, depending on what your particular trade is. If anyone's got a fixed zoo cage at home, that's entirely up to you. But if that's in your trade, you're able to claim capital allowances. And I kid you not, right? A sheepdog is an item of plant and machinery in the law. So if you operate a sheepdog, if you have a sheepdog for your business, you can claim capital allowances on your sheepdog. Not the sheep, that would be ridiculous. But the sheepdog, you definitely can. So it very much depends on your particular trade, what you do, if you can claim tax relief on there. And just as a sort of pictorial demonstration, if you like, these are sort of typical items of plant and machinery that we see every day. You know, and you don't have to imagine what a radiator looks like, for example. But these are all the sorts of things that we're generally looking for when we sort of go to site and have a look. Now, it kind of makes sense if you sort of analyse it a bit more that capital allowances, different properties attract different levels of capital allowances. So some people target properties which are great for capital allowances, and we certainly find it if people are buying properties sort of ex-offices or dental surgeries or anything where it has a fairly high level of plant and machinery. That's good from your buying point of view. I know I mentioned 20% at the beginning, but that's just kind of a rough estimate of the sort of levels of capital allowances you can get. So this is kind of a good idea of the sort of amounts of capital allowances that might be available if that's your strategy targeting those. But again, don't underestimate the benefit of the development works. Very often, the development works will yield more capital allowances than purchasing the property, mainly because we don't have to consider the land value or the reconstruction cost of the property. It is purely based on the invoices which capital allowances that you've claimed for. So I'm going to talk you through the overall process, which is typically about 4 weeks. But there's a very important bit on here which I'll come on to you. First of all, yeah, we do a desktop appraisal just to say this type of property that you're looking to buy or have got, this is the level of allowances that we'd expect to find. It's a cost-benefit analysis, essentially. But the next biggest step that we have to do is the compliance work. Now, we have to do some due diligence based on a number of things. One is that we have to look who you're buying the property from, because the not new legislation, but some new rules have come out to say that you can only claim capital allowances once on a property's lifetime. So that makes it a bit tricky, because then what do? Do you go to the previous owner and say, or the seller, and say, I want to claim the capital allowances. Have you claimed any capital allowances? Because you then run the risk of them going, I've never heard of capital allowances, but thanks very much. I'll go and speak to my accountant, and then maybe they might decide to claim it instead. So that's a real problem. Now, fortunately for you guys, there's a dedicated database that has got all the capital allowances that have ever been claimed in the country. which is great news. Unfortunately for you guys, it's owned by HMRC, and I've been asking them for the last 12 years for a copy of it, but they don't do that. The onus of responsibility is on the taxpayer to claim, to identify if they're entitled to claim, which is part of our due diligence process. So it's very important, this. It's very important that you know who you're buying the property from, because the rules also say now that you need to agree the capital allowances value with the seller. But it's the same problem in that you don't want to have that conversation with them because, let's say, you might alert them to the fact that they can claim capital allowances. There's a few ways around that, and generally we don't have a problem. As I mentioned, the reason why it's generally not a problem is that the sellers aren't interested in capital allowances. They're either uneducated in capital allowances or they're not interested. They just want the sale price of their property, sign the paperwork, and then move on to their next deal or their next stage of their life. So that's to your advantage. Generally, we put a clause in the contract which says that they, the seller, will agree to the values that we, or you, the buyer, will identify and undertake their necessary obligations in accordance with the legislation. So that's generally what happens in most cases. In a few cases, there is a process. If the seller really doesn't want to agree to anything to do with capital allowances, you can go to the tax tribunal and get them to effectively adjudicate on you, which sounds a lot more scary than it actually is, but it's an administrative process and not a very efficient one at that, I'll tell you. We're currently working on cases that we started 10 or 11 months ago, and they're just not very efficient. They have to write to the revenue have to write back, and you can't send them any emails or attachments. You've got to print everything. Anyway, it's a nightmare. But the compliance process is something which has to be done fairly robustly in order for you to claim. So if we take anything away from today, I would say just be aware of who you're buying the property from, and you've got to get that agreement in place, either through the contract or done separately outside of the contract, but you have to have that agreement in place. So one thing I was going to mention as well was something else about compliance. It'll come back to me in a minute. But once we've done the due diligence, then the process is then going to the sites and doing the valuation. The valuation side of things is based on a site survey for a purchase of a property, whereby all of the plant and machinery is detailed and logged. Or if you're doing development works, again, there is a site survey that's required, but obviously you will have copies of all of the invoices, or the invoices from the contractor, and we go through those first and effectively reconcile what we find on site against what's on the paperwork, and do that. Oh yeah, my piece about compliance. So I mentioned that the previous owner is really useful to know who they are. If the previous owner couldn't pay any tax, then you don't have to do this compliance process. So all of a sudden you start thinking, well, okay, who doesn't pay tax? Certain sectors of society are very good at not paying tax because they're exempt. So if you're looking to buy properties, let's say from the local authority, the local council, for example, the local council don't pay tax. They spend your tax dollars. So what they're able to do is you don't have to do that due diligence, or we don't have to do the due diligence, and all of the capital allowances automatically go over to you. So you don't have to have this done. Likewise, if you buy a property from a pension fund or from a charity, then automatically the capital allowances pass over to you. And likewise, if you buy from a developer who had the property as stock, they couldn't claim capital allowances either. So you by default get all of those. So it's really interesting. It's really important to know who you're buying the property from. Typical examples that we've had a lot of recently are people buying houses, dwelling houses, private houses, which of course don't qualify for capital allowances. So you automatically get the capital allowances there. And then transforming them into holiday lets or serviced accommodation, which do qualify. So that's quite a nice, neat process because you don't have to go back and check the previous ownership on there as well. So yeah, the site valuation and then the reports that we get go through your accountant into your tax return. Very straightforward. And one thing I will mention about tax returns, you can actually go back and change previous tax returns. So for example, the 18-19 year, which probably like me, you guys submitted on the 31st of January this year, you can actually, you've got until January 2021 to make changes to that tax return to claim for things that you might not have claimed for, like capital allowances, for example. So you can go back and get a retrospective a rebate from the revenue. So, so yeah, that's that. So it's great to consider if you're planning to buy these types of properties, consider capital allowances in your forecasting. And if you're an existing property owner, you may already have some of these properties which could benefit. I mentioned about property developers not being able to claim capital allowances, but they can still nevertheless benefit from capital allowances, because what we've found is there's not a lot of knowledge about capital allowances out there. There's getting more and more, but it's still a very niche area which not many people know about, or know about in a good way. But if you are a property developer, then wouldn't it be great if you're selling your property, that you know it claims, you know it qualifies for capital allowances, you could provide that sort of indicative level of value of capital allowances to the buyer. So all of a sudden you're making your property that you're selling more attractive than your competition. They might be looking at one unit of yours to trade as serviced accommodation, or another property over there which is exactly the same, say, same price for serviced accommodation. But you as a smart developer might be able to pass on that knowledge of capital allowances, which in turn reduces your investments, your investors' net investment. So it's another way to benefit indirectly from the capital allowances. And again, if you're building a portfolio or just looking to maximise your returns, knowing that these properties benefit from capital allowances, you can have that. I'm going to zip through a couple of these slides because I've only got a few more minutes to talk. So just some examples. And again, if you want copies of these slides, just drop me an email, or drop Josh and his team an email. I'm sure they'll be more than happy to distribute those, or me at the end if you wish. So these were some offices that were converted into HMO units, and the property was bought, so we made a claim on the purchase, and then it was developed as well. So we could make two claims, one for the purchase of the property and one for the development works. The overall investment in the property was £360,000, and the plant and machinery value was £95,000. But look at it in a different way. This means that this property investor had a £95,000 tax loss to offset either against other income or to roll it forward to offset future years' profits. In this particular case, he used it against his other income, and he managed to save nearly £40,000, which he was able to then reinvest into another property there. This is another one where the property was bought and converted into serviced accommodation units. There was, again, two claims. It's not quite finished at the moment, which is why they're quite round figures. But the overall works, purchase and development price is going to be just over 200,000. The plant and machinery value, it's going to be about 45,000 on that one. The LLP structure, they'll each be entitled to the share of that £45,000 worth of capital allowances, which could save them up to £18,000 on this one. Now, this was a residential property which was bought for a holiday let, and the overall investment and development work, £600,000, and the plant and machinery value there was 139. It was the start of their holiday let business, and so what they did is they didn't have any previous profits to get tax back from, but it meant they started their holiday let business with £139,000 tax loss. So what that meant is that they don't have to pay any tax until they make profits of £139,000, which is great. So they can factor that into their forecasting, knowing that they don't have to pay any tax for the next few years. And when they do, again, it'll be at the standard tax rate. But the couple, again, who owned it, it's going to save them over £55,000 if they hadn't claimed the capital allowances. And again, this is another property where it's quite a complex one, this. But again, the purchase price and development works, £675,000. The plant and machinery value will be about £190,000. And the limited company there will save about £37,000. They bought it, developed it, sold off some of the units to fund the works. But again, this new business has £190,000 tax loss to offset future years' profits. So if they're making £20,000 profits a year, well, that's great. They won't have to pay tax for 10 years on that as well. So just just to give you an idea of that, and I'll buzz through these. I've been talking mainly about plant and machinery allowances, but there's two very sexy things you should know about as well. We talked about structure and buildings allowance for commercial properties, but one of the best things, a couple of other things you should know about: land remediation relief and enhanced capital allowances. So land remediation relief is a tax relief which is available for contaminated land or buildings. So it's one of the single biggest, well, it's not the single biggest tax relief the government offer, but it's a massive tax relief. 150% of any money you spend cleaning up contaminated land or buildings, which is generally Japanese knotweed or asbestos. We find oil, petrol as well, you're able to claim, but they're the main ones. Any money you spend on Japanese knotweed or asbestos, you get 150% tax relief on that as well. There's a few caveats in there, but it's a really, really little known tax relief. I'm sure some of you out there must have looked at a particular site and gone, well, it's got Japanese knotweed on, no thanks, I'm going to walk away. But knowing there might be a tax relief or a different angle to look at it might mean you think twice about that particular site. If you know it's going to cost you £50,000 to deal with, well, that means you've got £75,000 of tax relief available to you. It might put a different angle on it. But really useful to know if you're a developer as well, because very often developers buy sites with these problems on to develop. And being a developer, you can actually benefit from land remediation relief as well. Not at the 150% level, unfortunately, but you still get 50% of the relief on there. So it's quite important. Can only be claimed by a limited company. And there's an example there where there was a petrol station that was available down in Cardiff, actually, a lovely part of the world. And it had, unsurprisingly, sort of hydrocarbons in the ground. And the costs to deal with all of that by pulling out the tanks and backfilling were going to be about £72,000. That had the effect of dropping the corporation tax by £20,000, making that particular claim. But that's quite interesting. And enhanced capital allowances. I mean, as if they're not exciting enough, right? There's an enhanced version of capital allowances. And this is really generally for bigger projects which have energy efficient solutions, if you like. So there is a list, sorry, I've gone too fast on that one. There is a dedicated list on the government's website of everything that qualifies for enhanced capital allowances. And it generally tends to be for bigger projects, certainly at the moment, because the enhanced capital allowances are over and above your yearly capital allowance, which is currently at £1 million. So if you bought a property which had £1 million worth of capital allowances, currently you can claim all of those at once. But if you have enhanced capital allowances in your project, for example, a high temperature wood pellet burner on the left, or sort of heat recirculation on the right, then you can claim those capital allowances all in one go. That's over and above your £1 million limit. But again, most investments these days, the £1 million limit covers anything. And this is just another example of, this was a property that is in Dubai. We're able to claim capital allowances on that because the owner of the property disclosed all of their income, profits and losses to the UK and pay tax in the UK for that property. And because it qualifies, you're able to then claim capital allowances on that. So penultimate slide there, I don't want to bore people for too long. What we found is up to £28,000 of tax can be recovered for every £100,000 spent on property. So if you consider that when you're forecasting your types of properties, that can make a massive impact. Again, looking at or knowing the benefit of capital allowances, that could increase your return on your investment in the first year if you get all of the allowances at once to 11.9%, which could make some projects really quite viable. And again, if anything taken away from today, just consider the fact that you need to know who you're buying the property from. There's new rules in place regarding getting the benefit for capital allowances, and that could have a massive impact on the properties. So that's a very quick, a very high level sort of overview of capital allowances based not solely on conversions, but more around how you would treat commercial property or conversion property, sorry, on there. If anyone wants copies of the slides, please drop me an email there. More than happy to do that. Or you can, you can Google and find me. I'm sure you can. But I need to see if there's any questions, which there generally are.
Absolutely.
I need to unshare, don't I? Do I do that?
You can leave those there for a couple of minutes. Let
Okay.
everyone a chance just to get your details down. We are getting a bit pushed for time, so we only have a chance to answer a couple of the questions.
Yeah, no, that's fine.
What I might ask is if you've got a little bit of time later on, just look at the feed and then you might see a couple of questions in there.
Absolutely.
We'll just pick a couple of the first ones. So do you have to repay any of the capital allowances? So if you sell a property, I suppose if you sell it or it ceases to be used for within the trade or for any of the reasons, if it's HMO, if it ceases to be used for that, if you sell it, do you have to repay them at all?
Yeah, so lots of people think if I claim the capital allowances today, somehow there'll be some sort of, it's only a timing benefit where I'll have to pay them back at some point in the future. And what generally happens is if one of my clients is selling their property, we'll put a little clause in the contract called a Section 198 election where we fix, which is completely legal, the sale price of the plant and machinery to £1. So I'm sure people have heard of businesses being bought and sold for £1. We do this. It doesn't affect the sale price of the property. You sell it for whatever you need to do. But what you're doing is you're selling that proportion which relates to plant and machinery to £1 as part of the overall sales price. That means there's no clawback, and you effectively claim all the outstanding capital allowances at once on that particular one. If your property is a serviced accommodation unit, for example, or a holiday let, and then you think, well, okay, I don't really like that particular business, or I want to live in that property myself now as my home, then you simply don't claim any more capital allowances on that property. So generally, no, there's no issue around, you won't have to pay the capital allowances back.
Yeah, fantastic. What we'll do is, we'll wrap things up there.
Yes,
we've got a couple of questions just in the feed. And if you're happy just to go through and address those one by one, there's a couple of people might be interested in having a survey done on an estate property, and they just wonder what the costs are around that.
No problem. I'll go through
they're all in the comments, and Arthur about to help you on those. Thank you very much for donating your time towards the event. It's always been great listening to you speak. I always learn something new. And again, for people out there, it's going to be hugely valuable in terms of the content you've covered, and importantly, the tax you've saved them. So I saw some of the numbers you put there. They were quite big numbers. So even if people donate 1% of a typical tax saving of £20,000, if you donate that to the NHS, that's a small price to pay for this. Everyone's come together for this event, so everyone's going to benefit. Just give a little bit of that tax saving to the NHS, and let's raise some money for those guys.
Excellent. Perfect. Thank you very much.
What I'll do now. Yep. Thank you very much. I shall speak to you later on.